So guys, one of the hardest things about dividend investing is figuring out the right companies to invest in, especially if you're just getting started with all of this stuff. Trying to build out your portfolio can make you feel like you're just blindly throwing darts at a board hoping for a bullseye. Which is why in today's video, we'll be building out the perfect market-beating portfolio with just 10 stocks. Now, our goal with this portfolio, guys, is to create something well diversified. So because we're only choosing 10 stocks, we're going to want to have exposure to a wide range of sectors and industries. We'll pick one, maybe two stocks from a handful of different sectors, which will help us reduce risk because things won't be too overly concentrated in one individual company or one individual area of the market. Along with that, we'll also want this portfolio, obviously, to be one we can count on. You know, we want to be able to sleep well at night with our money invested into this portfolio. And of course, we'll want to make sure that this portfolio performs well. So we'll be putting our money into bigger blue chip companies, many of which should be recognizable household names and for the most part have a history of delivering solid total returns. And with that said, on the topic of returns, it's important to mention that whatever might have happened in the past doesn't mean that it's guaranteed to happen in the future. So any of these stocks that have outperformed the market may possibly not do so moving forward. They totally could, but it's just not guaranteed. Anyway, last thing, guys, because this is a dividend portfolio, we are looking to invest in companies that have a track record of making consistent dividend payments, which they're increasing every year. And many of these blue chip companies offer that and have done so for quite a long time, as we'll see here pretty soon. Now, the first couple of stocks in our perfect portfolio will be coming from the consumer staples sector, and this is one of my favorites to invest in, and you'll be familiar with a lot of the companies in this sector. As the name suggests, these companies build their business around products that are not very cyclical in nature, so they're pretty much always in demand no matter what's going on in the economy, which makes this a pretty stable and defensive sector to invest in. And as you can see, some of the companies that make up the consumer staples sector are ones like Costco, Coca-Cola, the Hershey Company, Pepsi, Procter & Gamble, Kroger, and Walmart, just to name a small handful. And while I think all of these companies are great to own, for our portfolio here, we're going to select Kroger, which is one of the leading grocery chains here in the United States with over 2,700 stores across the country. And they operate under several banners like Fred Meyer, which is popular up in Oregon, Ralph's in Southern California, and Smith's here where I am in Las Vegas. Now, as far as the dividend stats go, we're not kicking things off with the highest yielding stock. You'll only be able to lock in a 1.7% yield by buying at today's prices. But that's okay, guys, because look at that dividend growth rate. It is off the charts at nearly 16% on average. And from the looks of it, the pace of that dividend growth has only accelerated in recent years. So anyway, that's going to be our first stock, guys. And in addition to Kroger, we're also going to pick another company from the sector. We're going to go with Procter & Gamble, which is one of my favorite dividend stocks out there. What I love about Procter & Gamble is they make things people use every day and will need to buy no matter what. I'm talking about things like toothpaste, laundry detergent, deodorant, diapers, paper towels, toilet paper, and so much more. And all of their brands really are the cream of the crop. And looking at the dividend stats, the yield and growth rate here for Procter & Gamble are pretty moderate. While we are getting a higher starting yield than what we saw with Kroger, Procter & Gamble's growth rate is less than half of Kroger's, so there is a bit of a trade-off here. But with that, Procter & Gamble is one of the most consistent dividend growers out there with a 68-year dividend growth streak. They've been growing this thing twice as long as I've been alive, which makes Procter & Gamble a dividend king. And overall, in my opinion, it doesn't get any more sleep well at night than a company like Procter & Gamble, which is why I think it's such a great addition not only to our perfect portfolio here, but also in my own personal portfolio as well. Taking a look at all of my holdings here, we can see that Procter & Gamble is my 9th largest position overall and my 7th largest individual position if we don't count the ETFs. And with 28 shares at an average cost per share that's only about 14% below the current share price, I would love to add more and make this an even larger percentage of my portfolio. And by the way, guys, what we were just looking at there was from Snowball Analytics, which is actually the sponsor of today's video. This is a really cool portfolio tracker that I think you would like a lot. We're actually going to look under the hood of our perfect portfolio later on in the video using Snowball Analytics, and I want to tell you a little bit more about it. One of the most essential tools for any investor is a solid portfolio tracker, and Snowball Analytics is like the Swiss Army knife of portfolio trackers. I've been using this platform pretty religiously to track my own portfolio for a while now, and I can't tell you how impressed I am with how much insight it provides into my portfolio. As you can see, the layout is very clean and intuitive, and and the platform overall is pretty easy to navigate. Plus, it's packed with more charts and graphs than you can count, which speaks to just how much data you get, not only for your portfolio, but also at the individual stock level as well. I mean, pretty much anything you want to know about a company's financials or dividend history can be found here within the platform. Now, in my opinion, what really sets Snowball Analytics apart are the features it has specifically designed for dividend investors. I'm actually convinced this platform was made for us, and here are some of my favorite features. First off, Snowball tells you your total returns by default throughout the platform, which may sound like a small thing, but it's crucial for dividend investors because it doesn't neglect the dividend income we receive when calculating returns. Most other portfolio trackers will only show your share price returns, which is really only half the equation, so it's refreshing to see dividends factored into these calculations. Additionally, Snowball has a pretty in-depth event calendar that keeps you updated with upcoming news, dividend payments, and any other important stuff going on. And they even have a dedicated dividend calendar so you can see who's paying you each month, when they're paying, and how much they're paying. Beyond these tools, Snowball also has a community section where you can check out other users' public portfolios to see what others are investing in, which is always a fun thing to look at. Plus, they have stats for stocks and ETFs that show what's trending and what's popular among other investors. This makes Snowball not just a killer portfolio tracker, but also a great place for dividend investors to get new investing ideas. So overall, if you're looking for a great portfolio tracker, which once again is something that every investor needs, then I highly recommend you check out Snowball Analytics, which you can actually do for free. All you need to do is click the link in the description of the video or in the pinned comment, or just scan this QR code right here to get a 14-day free trial. And if you like it, you can save 30% on your subscription right now until May 21st, so time is definitely of the essence. I really love using Snowball Analytics, guys, and I know you will too, so definitely take advantage of this sale and save 30% on your subscription. Anyway, guys, getting back to it, still in the realm of consumers, we're going to jump over to the consumer discretionary sector, which is made up of companies like McDonald's, Starbucks, Yum Brands, Domino's Pizza, Wingstop, Nike, Lowe's, and Home Depot, which I think are all fantastic companies, but these tend to be a bit more cyclical than those in the consumer staples sector, so we'll see some more ups and downs with these companies depending on what's going on in the economy. And I really don't think you could go wrong with any of these companies. I think they're all pretty solid in their own way, but for our purposes here, we're going to go with Wingstop, which is a company I've been really excited about lately. Over the years, this purveyor of chicken wings has exploded into a global franchise, and they've built a pretty delicious business model that thrives on simplicity. Just chicken and fries, that's literally all they do. They're extremely focused, which I respect. Plus, their asset-light, franchise-heavy model has made them a very sneaky growth monster in the restaurant space, which has certainly trickled down into the dividend, as we can see here. Now, the starting yield's actually going to be the lowest of the day so far, coming in at only about 0.4%, which I know might be a bit of a turnoff for some of you, but hold on just a second, guys. There is something very interesting happening over here on the dividend growth chart. Those big spikes that we're seeing every other year there on the chart are actually special dividends that Wingstop pays out to shareholders. And those special dividends can be somewhere between 5 to 10 times the amount of the regular dividend, which is crazy. And those special dividends are throwing off the dividend growth rate over on Snapstock. But here from Seeking Alpha, without the special dividends, we can see that Wingstop truly is a dividend growth monster with a near 20% 5-year CAGR. So once again, even though Wingstop's starting yield is admittedly low, don't underestimate the power of an extremely high dividend growth rate. Moving on, now we're going to take a look at the technology sector, and there are a handful of very dominant, very recognizable names that come to mind. Companies like Apple, Google, and Microsoft, and I really don't think you can go wrong either way because all of these companies have just obliterated the market these last 10 years. And I know many investors like to have one, if not all of these stocks in their portfolio, but for our purposes here, because we're just sticking to 10 stocks, we're going to go with Google, which has its hand in so many different things. At the core is obviously Google Search, which still prints money thanks to advertising, but they've also got YouTube, and that ad revenue is pretty monstrous as well. Then there's Google Cloud, which is growing incredibly fast, in artificial intelligence, which is definitely a huge growth avenue for them, and they're building AI into pretty much everything they do, from Gmail to Docs to cloud. But then with those, you've got the fun moonshots like Waymo, which are self-driving cars. You've got Verily, their life sciences division, and tons of other stuff going on under the hood. But with that said, as far as the dividend stats go, there's really not too much to speak of here so far. Alphabet just started paying a dividend last year, and they've only raised the dividend once, which they did last month. So I think things are still TBD with the dividend, but I think they have all the makings to be a great dividend growth stock moving forward. Next up, guys, we're going to take a look at the industrial sector, which I think is a really fun one because just within this sector, there are so many different ways to diversify. There are so many different industries that make up the sector, and many of which are critical to the infrastructure, not only in our country, but around the world. Now, there are a lot of great companies to choose from in the industrial sector, like Snap-on, Union Pacific, Caterpillar, Lockheed Martin, Waste Management, Republic Services, and Rollins, just to name a small handful. And even just out of this bunch, it's going to be hard to choose just one because all of these are really solid. But for our portfolio, guys, we're going to go with Republic Services, and I just talked more in depth about this company in my last video, but I think this is a pretty safe one to own considering that the demand for trash collection is as consistent and permanent as it can get. I can't imagine what could come in and disrupt a company like Republic Services, or Waste Management for that matter. Now, looking at the dividend stats, we can see that Republic is very consistent in that department and is also growing the dividend quite aggressively. I know it shows a dip there in 2024, but I think it's missing one of the payments that they paid out for the year, and in reality, Republic has actually grown their dividend for over 20 years. So they're almost a dividend aristocrat, and I think a great addition to our perfect portfolio here. Now over here in the communication sector, we've got a few different options. We can go with Verizon, we could go with AT&T, or we could go with Comcast, which is going to be our pick for the portfolio today. Out of the three, Comcast looks to be the best and most consistent grower in the financials, which should bode better for the dividend as time goes on. And with that said, I think Comcast has the best dividend stats out of the bunch as well. I mean, their yield isn't as high as what you get from something like AT&T or Verizon, but the yield right now is still considerably higher than the company's 5-year average, which is great. Not to mention, the dividend growth from this company is looking very nice with a near 8% 5-year CAGR. Jumping over here to the financial sector, there's a couple different directions we can go with this one. We could choose to invest in a bank like Bank of America or JP Morgan, or we could go the credit card route and invest in something like Visa, American Express, or MasterCard. And in our portfolio here, probably no surprise to a lot of you guys, we're going to rock with Visa, which as we can see is one of the largest positions in my portfolio. I absolutely love this company. And out of the handful of different payment networks that are out there like Visa, MasterCard, American Express, between all of those, Visa is the largest and most dominant network out of the bunch. And as people pay for things with cash less frequently and continue to buy things more with their credit and debit cards, the value of Visa's network will continue to increase and the business will continue to grow. And because Visa is so profitable with an insane 50% free cash flow margin, as the business continues to grow, so should the dividend, I think pretty aggressively. As we can see, this has certainly been the case so far with Visa. I mean, like we've seen with a few companies today, the dividend yield isn't the highest, but that dividend growth rate is pure class at 15%. And they've been growing this thing for the last 16 years with no signs of stopping now. Now, my friends, our 8th stock today will be coming from the healthcare sector, and there are a lot of great ones to choose from, including pharmaceuticals like AbbVie, Johnson & Johnson, Merck, Pfizer, and Zoetis, along with other types of healthcare companies like United Health Group and Humana, and it's honestly pretty hard to narrow it down to just one because there are a lot of good companies in this sector, but out of the bunch, we're going to go with Zoetis today, which is the world leader in animal health and is also the newest addition to my portfolio. This company was actually established as a spinoff from Pfizer back in 2013, and they make medications, vaccines, and other animal health-related products for cattle, fish, poultry, as well as companion pets like cats and dogs, which is currently seeing growing demand driven by what the company refers to as the human-animal bond. Now guys, speaking of growing, we are definitely seeing that here in the dividend department. The yield is sitting just over 1%, which once again, we're not getting the highest yield, but man, that growth rate is on fire. The highest of the day at over 21% on average. And like I said a moment ago, this is the newest addition to my portfolio. I just started buying it a few weeks ago, and so far I only have about 24.5 shares, but I'm adding to this position every single week and would not mind making Zoetis one of my top 5 positions. It's slowly but surely getting there. I just think this is a very solid company and it's growing like a weed, which makes me so excited to be along for the ride and to have it in our perfect portfolio here today. Now for our second to last stock, we'll head over to the energy sector, where we'll want to go with either Chevron or ExxonMobil, and I think they're both really solid options. I don't think you could go wrong either way. Both of these actually were formed from the remnants of Standard Oil, which was broken up back in the early 1900s and was split off into over 30 different companies. One of which was Standard Oil of California, which later became Chevron, and another was Standard Oil of New Jersey, which later became Exxon. But anyway, guys, for our portfolio here, we're going to go with Chevron, which historically has been the better performer of the two by a long shot, and they have the advantage in the dividend department with a near 5% yield, so a very high starting yield, and 37 consecutive years of dividend growth. And now, guys, this brings us to the 10th and final stock. And for that, we're going to jump over to the real estate sector. And here there are so many companies that I really like. It's incredibly difficult to just choose one. But we have Agree Realty, Prologis, Realty Income, and Vici Properties, just to name a very select few. And today, guys, we're going to go with none other than Realty Income, aka the monthly dividend company, which has a portfolio of over 15,000 different properties, with all of their largest tenants being companies that are pretty well insulated from changing consumer behavior, like 7-Eleven, Dollar General, Lifetime Fitness, FedEx, and Walmart. Now, like I mentioned a moment ago, Realty Income is the monthly dividend company, so they're paying out to shareholders every single month, and their dividend stats in general are pretty top notch. In the trailing 12 months here, we've got a yield of around 5.2%, which is the highest yield that we've seen today. And with that, Realty Income is also a dividend aristocrat with a 30-year dividend growth streak, during which time they've increased that thing by an average of about 4% every year. And owning Realty Income, I think, is kind of like a rite of passage for many dividend investors. It's definitely one of the most popular dividend stocks out there, if not the most popular dividend stock. And actually, guys, I'm curious, let's do a little roll call here. Let me know in the comments below if you have Realty Income in your portfolio. I'd be very surprised if we didn't see a lot more yeses than nos on this. But anyway, guys, with the addition of Realty Income, here is our full perfect portfolio, all 10 stocks right here. And overall, guys, I think we've built a very well-diversified portfolio, not only in terms of, different stocks in different sectors and industries, but also by dividend stats as well. I mean, if we categorize this by, highest yielding to lowest yielding, we'll see we've got quite a few high yielding stocks in this portfolio, like Realty Income, Chevron. I think Comcast is getting up there to be a higher yielder too. But then we've also got some solid dividend growth stocks with high dividend growth rates like Zoetis, Visa, and Kroger. And I even think that what we're seeing from Comcast, Republic Services, and Procter & Gamble is pretty respectable in the dividend growth department as well. And when you put it all together, this is what the overall dividend stats look like. Here in the portfolio, we have about a 2.3% starting yield just by buying everything at today's prices. And along with that, on average, we're getting about a 7% dividend growth rate. So I think these are pretty well-balanced dividend stats overall. And I'll say, guys, I think we've built a very solid all-weather, go anywhere, do anything portfolio. I think this really checks a lot of boxes and is very well balanced across the board. And like I said earlier, this portfolio overall has historically generated market-beating returns. And if you would have invested just in these 10 stocks over the last 10 years, starting back in 2015, you would have fared very well against the S&P 500. And just diving deeper into those historical returns using Snowball Analytics backtest tool, here we've got our 10 stocks, 10% weighting of each one, so it's all even. And just scrolling down, guys, in the setup here, we are starting with an initial investment of $1,000 back in May 2015, and every single month from then until today, we'll be investing $100 per month. And looking at the results here, it looks like we are getting this message that says the start date was actually July 2015 because that's when Wingstop became public. So we missed out on a couple months, but it's still all more or less pretty similar, guys. And overall, we would have outperformed the S&P 500 by about 31% in total since 2015. And then looking at the final balance here, starting with an initial investment of $1,000 and investing $100 every single month, you would have ended up with about $30,000 investing in this portfolio compared to about $26,000 investing in the S&P 500. And not only would you be left with more money, but you also would have received so much more in dividends, about $3,000 with this portfolio compared to the S&P 500's about $1,700. So it's almost twice as much in dividends coming from our perfect portfolio here. And it looks like the average rate of return return in this time period is about 15.6%, which is very solid compared to the S&P 500's 13.1%, which admittedly is also very solid. Now guys, as I was mentioning throughout the video, I actually have a lot of the stocks that we talked about today in my own portfolio. And in this next video right over here, I'm showing you my position in these companies along with the rest of my dividend stock portfolio. In this one, we'll get into every single one of my holdings, including the number of shares I have, the gain and loss with each position, and all of the dividend income I have received so far. So click right over here to learn all about that, and I'll see you in the next one.